Hi, everyone. I'd like to welcome you to our inaugural audiovisual presentation entitled Moving Forward by Looking Backward. This will be the first of a multi-part series, and I trust that you'll find it both thought-provoking and enjoyable. Before moving into the presentation material, I'd like to ask that everyone takes note of the disclosure language. This presentation is for informational purposes only, and please consult your financial advisor before making any investment decisions. Since this material is not tailored to any one particular individual situation, and Ape Capital Management's views may change as new information becomes available, and we may not be able to provide an update if this should happen. As many of you know, I enjoy quotes, and here are two of my favorites, which are attributed to Mark Twain. History doesn't repeat itself, but it often rhymes. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Perhaps Mr. Twain's most famous social commentary comes from the adventures of Tom Sawyer and Huckleberry Finn, and is based in the mid-1800s. Since much of this presentation will focus on a book entitled The Rise and Fall of American Growth, which highlights the great innovations of the late 19th and early 20th century, it strikes me how different the lives of these characters and those around them might have seemed had they grown up a century later. As we delve into the presentation, I try my own hand at a Twainism, which I hope encapsulates a core message of this presentation. Forgetting the past is folly, but extrapolating it without reason ain't much better. So what are we looking to accomplish over these series of audiovisual presentations? First, I'd like to provide a historical context to articulate Abe's vantage point on economic and market structure today. Differentiate information that's structurally meaningful from that which is likely to be short-term noise. What is structurally meaningful? Structurally meaningful means that it's unlikely to change significantly, and it's important to understand to preserve and grow wealth. From structurally meaningful information, you can differentiate implications that are likely to be knowable versus unlikely to be knowable, and we can allow this framework to guide long-term asset allocations and security selection. In 2018, I shared with clients a book entitled Factfulness, written by Hans Rosling. I shared it because the public narrative often seems so depressing. Even the nightly news seems to have scary stories about everything from your toothpaste you use to the broccoli that you eat are going to kill you. So I want to provide a data-backed, optimistic view of the world and highlight how far we've come. And despite some of the structural challenges that I'll be presenting over this video and future videos, I do maintain optimism that living conditions across the world will broadly improve in the future. Just probably not as fast as they have in the past, and not as fast as many of us would hope. The chart on the left highlights GDP per capita in 1960 versus 2014. As you can see, only a handful of countries lie below the line where they had negative growth over this period. The vast majority had positive real, after inflation, growth, and quite meaningful real growth. The charts on the right highlight that despite the concerns of Mr. Malthus in his 1798 piece entitled An Essay on the Principle of Population, we have managed to expand the global population over sevenfold, as well as materially reduce the percentage of people living in extreme poverty. While I understand that definitions of extreme poverty are murky and much progress needs to be made, it's important to appreciate the tremendous progress that has been made. We will get to this a little bit more later in the presentation. This next slide provides context for the United States growth in GDP per capita since 1871. Perhaps this highlights why the United States has historically been viewed as a land of opportunity and economic growth. While we will at a later time discuss the relationship between economic growth and market returns, this chart from esteemed Wharton professor Jeremy Siegel illustrates the real returns. Again, real means growth above inflation. It illustrates the real returns of various types of investments in the United States over 216 years. As you can see, during this period of broadly strong economic growth in the U.S., $1 invested in the stock market compounded to nearly $1.4 million in real terms. $1 in bonds resulted in $1,600 in real terms, and gold only $3 in real terms. The obvious conclusion that where economic growth has been quite strong over long periods of time, Similarly, investing in stocks has provided great wealth enhancement over those long periods. The real return on other assets, ranging from government bonds, bills, gold, and dollar assets, have been much less impressive. Perhaps this is why Mr. Siegel's book was entitled Stocks for the Long Run. And the implied message is if you want the great returns provided by stocks over time, you need to assume the short term riskiness they entail and ride out the cycles. While we don't dismiss the conclusion and generally tend to agree, we would say that there are nuances around this conversation that most people or even institutions don't have a 212-year investment horizon. To paraphrase legendary investor Howard Marks of Oaktree Capital from his 1996 investment memo entitled Risk, where he says that in good times, people stress that if you want to make more money, the answer is to take more risk. Effectively, risk and reward moves up and to the right together in what is referred to as the capital market theory. But as Mr. Marks wisely highlights, if riskier investments reliably provided higher returns, they wouldn't be riskier. If I can rephrase, just because you assumed risk doesn't mean that you'll be rewarded over any particular period of time. And frankly, those who assume risk, when this is most widely believed, are likely to be the ones who are most likely not to be rewarded for this assumption. So, what if we were lucky? Over the last few years, I've decided to revert back to a passion of mine, which is reading history, especially economic and market history. One of my favorite books was written by legendary investor Barton Biggs. It's entitled Wealth, War, and Wisdom. In this book, Mr. Biggs describes the ability of markets to be predictive of future economic and societal changes, and also highlights how certain countries and asset classes perform during periods of great upheaval, as he describes it when the four horsemen of the apocalypse take ride. Mr. Biggs highlights that in the 20th century, certain countries could be described as the stable, lucky ones, and others as the losers. Effectively, being a lucky country might include being the victor in world wars, or maybe not involved, like Switzerland, not being occupied or conquered by another nation or a group of nations who plunder your societal wealth, or not being ravaged by hyperinflation during some moment in your history. It could also be due to avoiding some pandemic like the Spanish flu of 1918 or 1919, which only killed 675,000 Americans compared to a global mortality toll of 20 to 50 million people. Although the losers might seem like they come from some Mad Max dystopia, the reality is that they actually include countries like Belgium and Denmark and France and Germany and Italy and Japan and the Netherlands and Spain. The stable lucky ones are largely Anglo-Saxon and either one or better sidestep some of the travesties of the 20th century. Comparing the stable luckies from the losers, it appears that the stable lucky nations earn roughly an extra 2 to 2.5% per year over the 20th century, with equities returning solid real returns for both the stable lucky at 6.5% and the losers at 4.2% real returns. The stable lucky countries also generated real returns on their bonds and bills, while the losers did not. This was largely due to the higher inflation that the losers had of about 2.6% per annum. It's important to realize that much of the difference between the stable and the losers stems from the returns during the 1940 to 1949 period. These charts from Wealth, War, and Wisdom highlight the tremendous annualized and cumulative losses during this period for the losers. For example, the average loser generated a 0.8% real return in stocks from 1900 to 1949, but an annualized loss of roughly 7% per year during the decade of 1940 to 1949. Excluding the 1940 to 1949 period, the returns would have actually looked quite good. In bonds, the losers fared poorly throughout much of the 1900 to 1949 period, but the true wealth destruction generally happened in that final decade of this period. Interestingly, safe government bonds actually materially underperformed risky stocks during the 1940 to 1949 period when the four horsemen of the apocalypse came to town. While these are only a few countries in a broader globe, the domestic biases of many investors to overwhelmingly invest in their home countries make such outcomes only a modestly extreme example of risks to wealth destruction. Furthermore, the increasing focus of index funds creates an environment where people feel they're diversified, but the assets and correlations amongst their investments are actually much higher and often near identical. Finally, and most importantly, how many even wealthy people could emotionally hold when their assets decline by roughly 60% in real terms over a 10-year period? This becomes even more problematic when you have required payouts like a pension plan, an insurance company, or a retiree that might be forced to sell as their assets decline. We'll share more about this in a future presentation where you'll get to meet our friends Unlucky Irma, Lucky Lucy, and Smart Sally. To combine the Jeremy Siegel presentation on stocks for the long run with Barton Biggs' views on the lucky versus unlucky dynamic with the power of compounding, I felt I would illustrate the growth of $1 invested in equities, bonds, and bills for the stable lucky ones and the losers. As you can see, $1 invested in stocks turned into $543 during the 20th century, and $61 for the losers in the 20th century. Bonds and bills in the stable lucky ones turned in roughly $6 and $3 respectively. So the losers who invested in stocks over the past century actually saw their stock purchasing power expand tenfold compared to the purchasing power of the bond portfolios of the stable lucky ones. Based on this analysis and Mr. Siegel's, over a long period of time, equities have been much better preservers and enhancers of wealth, but geography and geopolitics can have a material impact on the degree and even the direction of outcome over various periods of time, and it's very difficult to predict with any sort of foresight. Wealth destruction, unlucky periods of time, can occur quickly and unexpectedly. Even during World War II, the German markets peaked in November of 1941, just before Barbarossa stalled at the gates of Moscow. Similarly, the Japanese market peaked just a few months after the Battle of Midway in June of 1942, as the market started to sense a turning point despite Japanese propaganda highlighting Japanese successes and an emerging empire of wealth in Southeast Asia. So on to the next section. What is economic growth? GDP is gross domestic product. What is GDP though? It's effectively how much stuff did the economy produce, where stuff is the goods and services that are produced. So economic growth, if you want to kind of break it down though, is how many people are working and how productive are these people. The growth in economic growth is basically how many more people are working than the period before and how much more productive is that average worker. Other factors to consider could be you can measure things before or after inflation, being nominal or real. You can look at each country, being region or household, etc., has its own GDP that impacts global GDP, and debt borrowing can actually impact changes in GDP as well. Perhaps a bit of a reiteration from the chart earlier, but the chart here on the left shows real GDP growth in the United States since the beginning of the 20th century. The chart on the right highlights that there is some volatility associated with the rate of change, here since World War II, but recessions, which are in the gray shaded area, tend to be brief relative to periods of growth. Another point to note is that the decline in volatility over the period and the relatively low level of real growth since 2000 compared to the preceding 50 years. Since I tend to be a little bit of a sucker for long-term historical data and charts, I'm probably a bit biased towards the importance of this chart. That being said, I think it's instructive for what is to follow. I found this really interesting data set which illustrates English, being the UK, Britain, real economic output, GDP, going back nearly 750 years. Although some might argue that the scaling of the chart on the left distorts how much economic growth came in the last 150 or so years compared to the prior 600 years, I decided to illustrate the annualized real GDP across 50-year periods. As you can see on the chart on the right, annualized real GDP was effectively flat from 1270 to 1650. There was a period of more rapid growth in the latter half of the 17th century, which, as you'll see in a forthcoming presentation, aligned with the British rise on the world stage in an effort to usurp global hegemony from the Dutch. It's not too dissimilar, actually, from the Thucydides trap, which may be going on right now between the US and China. But that's a story for another day. That being said, the period of 1850 to 2000 which included two world wars and a Great Depression, actually generated real economic growth at a rate six-fold the rate of the 580 years prior and nearly 50% greater than the 16 years following. A remarkable period indeed. Although we're not claiming direct parallels, we believe that much of this differentiated period of historic growth in England is reflective of similar trends ongoing in the United States that we saw earlier. First, we saw rapid growth in the number of people working, labor force growth rate. And you can see here on the chart on the left that civilian labor force grew over 1% per year from the 1940s through the 1990s, with a peak of nearly 2.6% per annum in the 1970s. This was driven by various factors, including general entrance into the workforce of the baby boomer generation, women more broadly, and migration patterns. We will get into the drivers of these developments later in the presentation, but you can see labor force participation rates for males remain roughly static between 1870 and 1970, in excess of 90%. But female participation rates increased from just over 10% in 1870 to roughly 50% by 1970 and over 70% by the year 2000. On this slide, we share some of the charts that show the influence of increased births, basically the baby boomer generation, entering the workforce, as well as a tendency towards welcoming growth in our labor force through immigration in the United States. Although I haven't confirmed the data, I'd imagine that survival rates help to drive the aggregate number of workers in the late 19th century to the early 20th century as well. According to Professor Gordon's book, roughly 50% of people would anticipate to survive to 50 years old in the year 1870. By 1940, that figure approached 80%. By 1997, it was closer to 90%. While some of this investment stemmed from lower rates of infant and childhood mortality, the general introduction of modern conveniences, basic improvements in health standards, and change in workplace and household conditions, which are described in following slides, must have had a big impact as well. Unfortunately, as you can see in this slide, according to the U.S. Bureau of Labor Statistics, the labor force as like a driver of growth is expected to be at a much lower level than it's been based on our historical expectations. Some would even cast doubt on the 2030s and 2040s estimates as derived by optimistic expectations in light of the lower birth rates of today. This is a very important chart to consider if we remember that the growth rate in the labor force is one of actually the two core levers of economic growth. While it might be easy to be dismissive since the US is just under 20% of the global economy today, this trend is arguably worse across much of the world, with severe declines expected in places like Europe and the more economically advanced Asian nations. Now, this chart is merely changes in participation rates, but it broadly reflects the aging of these societies and the greater number of dependents relative to the people who are producing. When faced with a discussion on how demographics will develop over time in the broader developed world, people often cite Japan because it kind of came first in this regard, and it's seen a peak in working age population in the late 1990s. What was interesting to me while I was conducting this research was that while Japan did see a decline in total employment from the late 1990s through roughly 2014, it actually recovered most of these workers, as you can see on the chart on the right, through growth and those working beyond the age of 64, increasing women entering the workforce, and even a slight increase in foreign workers. Ironically, men between the ages of 25 to 54 have seen a decline somewhat. Essentially, Japan has tried to offset the demographics' destiny mantra of a 12% decline in population aged 15 to 64 since the late 90s with a more inclusive work environment. So in this slide, we have two charts. You can see on the chart on the left-hand side, the tremendous growth in the Japanese workforce since like the early 1950s. The workforce peaked in like the late 1990s and only started to rise over the last few years based on the factors just described in the prior slide. The chart on the right actually highlights this growth, but sadly is only a modest uplift of roughly 1% per year versus the 1.5% annualized growth from the 1950s into the 1990s. And this will be further challenged by Japan's very high participation rate and the expectation that its population will decline by nearly 1% per year over the next 30 years, from roughly 125 million people to under 100 million people. As we consider what the United States' future economic growth might look like based on its current labor force growth expectations, it's interesting to look at the growth of the Japanese economy, as we can see in this chart from the late 1990s. Effectively, there's been very, very little economic growth at all, which ties back to the barely any growth in the labor force. The aging of populations and the impact on labor forces not only challenges to economic growth in developed markets, but also certain developing markets. Take China, where its workforce may already be shrinking after many decades of growth in the working age population. Although the offset might be able to continue by moving hundreds of millions of people from less productive regions and rural jobs to urban positions and more manufacturing or more service oriented jobs, the impact of the one child policy presents a challenge that China will, as they say, grow old before it grows rich. So now we're going to go move along to the other portion about how to grow GDP, which is the increasing the productivity of the labor. While this is arguably less forecastable than the number of people of a certain age over the coming years, and measurement has its dissenters, the book mentioned earlier, written by Professor Gordon of Northwestern, really opened my eyes to why our future expectations of global growth and U.S. growth may be misplaced because the impactfulness of the innovation in prior years is unlikely to be replicated to the same extent. And this isn't a failure of our current efforts to innovate, but rather more a statement about how unique the prior period actually was. For a frame of reference, to see the world average GDP per capita, which is kind of reminiscent of the English chart and the US GDP growth charts from earlier in the presentation, take a look at it on the bottom left of this slide. For an initial sense of context, this slide has a broad overview of U.S. demographics in 1870, in 1940, and in 2010. The population, as you can see, has grown from roughly 40 million to over 300 million in 2010, and now it's closer to about 330 million in the United States. It's been roughly a 1.5% annual rate of growth in the U.S. population over time. As you can also see, the birth and death rates are down materially, and perhaps not surprisingly, the percentage of people under 24 years of age is sharply lower than in 1870, and those over 65 are sharply higher. Finally, as noted earlier, the female workforce participation rate is significantly higher today than it was in 1940 or in 1870. On this slide, we take a look at the type of labor employed in the economy over these periods. Interestingly, farmers and farm laborers represented nearly half of those occupied in 1870, but only 1% in 2009. Combined with blue-collar jobs, these categories of professions, which might be deemed not only highly demanding, but in prior eras quite dangerous, have declined from roughly 80% of those occupied to roughly 20% of those who are currently occupied with labor and work. While opinions may vary, my hunch is that most of those working service occupations or manager, professional, proprietor professions today would much prefer these conditions than the farming and blue-collar jobs of the late 1800s. The increase of both wealth and productivity has shifted how consumers spend their money. Whereas perishable goods, mostly food, alcohol, printed material, lighting, fuel, has declined from over half of consumer expenditures in the late 1800s to under 10% today. Clothing and footwear and materials to make it are now purchased at stores and represent roughly 3% of expenditures versus roughly 15%, which were largely made at home in 1869. In summary, food, clothing, and energy have increased generally from decreased generally from roughly 2/3 of the consumer budget to slightly over 10% of the consumer budget. Inclusive of items listed under services like food services and accommodations and household utilities, the figure goes up to roughly 20%, but still a far cry from where it was in 1869. As the chart on the right highlights, spending on categories that didn't even exist in 1869 now account for nearly 60% of consumer spending. In Professor Gordon's book, The Description of Life Prior to the Basic Networking of the Home and Work Premises to Modern Conveniences, which we take for granted, provides the most fundamental basis for why I believe that attempting to match the productivity of this era will be highly unlikely going forward. It's important to remember that growth comes from improvements in productivity. So what existed before is a key driver of the degree of change coming from innovation. Take, for example, running water and the life of a typical North Carolina housewife in 1886. She had to carry 8 to 10 times each day, washing, boiling, and rinsing a single load of laundry, used about 50 gallons of water. Over the course of a year, she walked 148 miles, toting water, and carried more than 36 tons of water. Not only was the water carried in, but dirty water also had to be carried out, not to mention the unpleasant task of emptying chamber pots. Next, let's spend a minute considering the impact of Edison's electric light bulb. Edison's marvel of electricity came to fruition at Menlo Park in 1880, and the initial Edison electric light bulb was roughly equivalent to a kerosene lamp. But by 1920, this price had dropped by a factor of 6. The electric light was 10 times more powerful than a kerosene lamp, and the same $20 would purchase 4.4 million candle hours per year. For context, by 1900, only 3% of American homes had electric service. But the annual output of electric power per capita doubled every 6 to 7 years, from 1902 to 1929. This was both driven by, but also helped to drive, an 81% real reduction in price from 1902 to 1929. The networking and electrification of the home allowed for innovation to leverage this network. Think about things like the washing machine, the refrigerator, the freezer, the electric stove, and you combine that with basic conveniences of life, like ease of bathing, reduced exposure to the elements, both hot and cold, and lessened potential health risks. This helped transform the lives and opportunities of households, both wealthy and poor, and urban and rural. As Professor Gordon so aptly well put, the century of revolution in the United States after the Civil War was economic, not political, freeing households from an unremitting daily grind of painful manual labor, household drudgery, darkness, isolation, and early death. Manual outdoor jobs were replaced by work in air-conditioned environments. Housework was increasingly performed by electric appliances. Darkness was replaced by light, and isolation was replaced not just by travel, but also color television images, bringing the world into the living room. As we turn to the next slide, I would be remiss if I didn't touch on the innovations in transportation, namely the automobile. I think we can all imagine what life would be like in most environments without an automobile. For those who live in places like Manhattan, consider the ease of getting goods to your island because of trucks. But the adage of addition by subtraction also applies. You see, by replacing the average horse from city streets, you also reduce the 20 to 50 pounds of manure and a gallon of daily urine that were applied by the horses without consideration to the location of the streets. And this might amount to 10 tons per square mile that would otherwise of various types of excrement that would work their way into the watering holes that families would use to bathe and to drink. And the bodies of dead horses would decay in streets until they were ultimately removed. On the farm, the invention of mechanical reapers could harvest a multiple of grain compared to men using prior tools. In 1915, tractors began to actually leverage technology to even further help farmers. In 1935, for instance, roughly 6 person hours were required to harvest an acre of wheat compared to the 20 that were needed in 1880. Corn technology in the form of hybrid seeds actually started to improve protections against drought and insects, and therefore that also helped improve productivity, and that began to take meaningful market share by 1940. All these innovations truly transformed the lives of people, both urban and rural, rich and poor. So the charts on this slide focus not only on the increased adoption of the technology, but you can see like the chart on the right that highlights like the vehicle and air miles surging into the 1970s. But they also highlight the lower cost per vehicle mile, which is the chart on the top left, and the increased safety of the technology on the bottom left. Technology was invented, and then it was adopted, and finally was made more efficient, safer, and often cheaper as well. So the impact on GDP growth from these innovations can't be understated. And it comes both in the direct value of the innovation as well as the time released by this technology. Similar to the chart highlighting women increasingly participating in the workforce starting in the 1920s, here we'll see a sharp increase in public and private high school graduates beginning around 1920. As these innovations create opportunities to leave the farm or the factory, kids could remain in school just as women could leave the home, since their house chores no longer required many hours of daily labor. Women, too, would be increasingly educated, and the overall increased level of education would likely make the workforce more productive members of society and of the workforce than the generation before them. Similar to many of the preceding slides on the networking of homes, machines to leverage the network, and innovations in transportation, much of the shift in the female labor force participation and increased education had occurred by the 1970s. The benefits of these graduates would be felt for a generation as a more educated generation replaced a less educated generation. Nevertheless, despite the attestation of their parents, children graduated in the 1990s and 2000s were likely not as differentiated from their parents in terms of education as their parents may have been from their grandparents. Just another reason why replicating the productivity of the past would be a challenge going forward. In this slide, Professor Gordon highlights the annual growth rate of output per person, output per hour, and hours per person. It's interesting to note that the output per hour rose roughly 2.8% from 1920 to 1970, compared to 1.6% from 1970 to 2014. Perhaps more interesting also is the average number of hours per person declined by 0.4% per annum, as hyper-fast output per hour productivity allowed for strong growth despite more free time. From what I read, the average worker went from 60 hours per week to roughly 40 hours per week over this time period. Alternatively, people have worked a bit more hours in the years of the most recent period, perhaps pushed by employers to meet certain targets that they set. These targets might be a product of a bygone era of productivity that will be difficult to replicate in the future. So on this slide, Professor Gordon tries to estimate future output per various units from 2015 on to 2040 and how they might compare to the 1920 to 2014 period. Professor Gordon is likely to be directionally correct based on the preceding materials which we've discussed, even though he will almost certainly be off by degree. His summary is that median output per person is set to decline from roughly a growth rate of 1.8% per annum to roughly 0.4% per annum. Disposable median income per person will likely decline from a growth rate of 1.7% per year to roughly 0.3% per year. This ties in the expected retirement of the baby boomer generation described above, which will cause hours per person to decline at a rate of 0.4% per year. While this actually would be similar to 1920 to 1970, it'll be more a function of choice due to productivity enhancement in the prior era versus demographic trends in the latter era. After factoring in the expectation of labor productivity declining from 1.2% versus 1.6% from 1970 to 2014 and 2.8% from 1920 to 1970, the big picture implication is that real GDP per person will grow at roughly 0.8%, which is roughly one-third the rate of 2.4% from 1920 to 1970, and not even half the rate of roughly 1.8% since 1970. Where skeptics argue that Professor Gordon is likely to be proven wrong is that technological innovation in the information age is inadequately measured in GDP. While I personally think that there are probably some merit to this argument, most of the detailed explanations that I have heard tend to be dubious. The value that people would ascribe to Facebook, which they don't directly pay for, or Google Search, which they similarly don't directly pay for, is perhaps not adequately measured in GDP. But other measures strike me as particularly dubious, including the amount of pictures taken this year is roughly 2.5 trillion, which is far greater than the 300 billion pictures taken in 2010. Arguably, you used to pay for picture printing, and now you only pay for data storage. So perhaps GDP doesn't reflect this value adequately. Nevertheless, I just struggle to see how, for most people, the taking of additional photos really creates value on a similar plane to the toilet bowl, the light bulb, and the automobile. While photography to promote a business and projects to inspire creativity, add value to society, I would 100% agree with this. But for people whom this is not a profession, when they spend time taking pictures of their friends, their family, or their favorite tree, and then spend some time sorting them up, that doesn't actually meaningfully add to societal growth and perhaps detracts from it when a few dozen other people spend time looking at the pictures online while maybe they should be working in their office or what have you. In this regard, I wouldn't be surprised if productivity growth at the workplace has actually declined because of excessive amounts of emails and the distraction that this can often present. Online searches on Google of matters that aren't directly related to work, or searching through other people's photos on Facebook. That being said, one innovation of merit has been the amazing advances of computer power over the past 40 plus years. Moore's Law, set out half a century ago by Gordon Moore, who I believe was a co-founder at Intel, predicted a doubling of chip density every 2 years. Not only has this trend line basically kept up with the remarkable expectations, but the pricing efficiency to the consumer has been a huge benefit at the home to the home and business computer. We may be coming to a point where computer power will be able to be leveraged and beneficial to businesses more so than the average consumer, who now has more computing power in his pocket than the Apollo spaceship actually had when it landed on the moon in 1969. Or at least this is what I'm told. While Professor Gordon recognizes how remarkable certain innovations like improvements in computing power are and the pace of new innovation, he seemingly defers to the line that it isn't the amount of innovation, but the impactfulness of the innovation that matters. And that being said, he generally regards the improvements in hardware, software, and various forms of audiovisual materials available to consumers to be more numerous today, but far less impactful than the great innovations of the 19th and 20th century. Furthermore, the rate of improvement, basically that change in productivity year over year that we were talking about, is a function of what existed before. So the hurdle was lower for the great innovations of the late 19th and early 20th century because the great innovations that they actually were didn't already exist at the time. Current innovations have those hurdles to overcome as well. Before I start sounding too much like a Debbie Downer, perhaps we are on the verge of a great new era of innovation with the impactfulness that will revolutionize human existence. Perhaps technology like software is like a child, which takes decades to nurture before you start to see the full impact of your investment. And perhaps the recent uptick in labor productivity, as highlighted on the right side of this chart, is promising. Nevertheless, the past 20 years have generally seen a much lower level of productivity growth than in the latter half of the 20th century. And I don't have comfort that any increase in photos taken is going to change this. I would also like to highlight a few additional trends that we'll discuss in greater detail in following presentations, but likely serve to benefit the economic growth and productivity over the past few decades that we were describing. First is the trend towards globalization. No matter what your thoughts are about globalization in this kind of hyper partisan world that we live in today, companies generally knew their cost structures and could allocate capital to where it would generate the highest productivity per unit of cost, at least on a global basis. And this trend might be in the process of unwinding. As the prior slide referred to trends in globalization going back over 200 years since 1800, amongst other factors, some known and others less well known, globalization likely contributed also to a lower and less volatile inflation rate, as excess or cheaper capacity in one part of the world could be used to get products to consumers at a lower price. Another thing to remember is that we live in a globalized economic community, at least today. So while the United States may have benefited from these great innovations from the early 1900s to the 1920s to the 1970s, many European countries were delayed in adoption of these technologies because of the world wars and their deficits associated with these wars. France actually refers to the period of 1945 to 1975 as the 30 glorious ones, which are reflected in their tremendous period of growth during this time. It's been said that the percentage of the French population have actually access to electricity and an automobile in 1948, 3 years after World War II, was roughly equivalent to that of the United States in 1912. In recent years, China has become the world's largest consumer of new automobiles and various durable goods as well. It's important to think about these different time periods at which various societies have managed to adopt the networks that the United States adopted in the mid 1900s and have leveraged them to their full productive capacity. So, low rates of inflation have generally been related to lower rates of interest. As interest rates have continued to decline, entities ranging from governments to corporations to households have taken on debt to help invest and to grow. This levering up of society might be able to continue, but arguably has its limits as well and is closer to them than maybe it was a few decades ago. As a topic we'll delve into in an upcoming audiovisual presentation, the debt itself helped to generate more GDP growth, as debt was effectively created to purchase goods, to innovate, and to raise the living standards of people to consume goods produced by others around the world. Perhaps increased debt was the world's best tool to maintain the growth of prior eras, which were blessed with better demographics and a more meaningfully productivity enhancing innovations. But I'll leave this for a future presentation. In the meanwhile, I hope that you found this material to be both enjoyable and thought provoking. I obviously welcome feedback on the content and the format, as I look forward to leveraging technology to improve my own productivity. In the meanwhile, looking forward to sharing more in the near future. And until then, wishing you well and thanks again for joining. Bye.